Which of Berkshire's businesses are best suited to thrive during a period of high inflation, and why? Which will suffer the most, and why?
The best businesses during inflation are usually the best. They're the businesses that you buy once and then you don't have to keep making capital investments subsequently. So you do not face the problem of continuous reinvestment involving greater and greater dollars because of inflation. That's one reason real estate in general is good during inflation. If you built your own house 55 years ago like Charlie did, or bought one 55 years ago like I did, it's a one-time outlay. Whereas if you get an inflationary expansion in replacement capital without having to replace yourself. And if you got something that's useful to someone else, it tends to be priced in terms of replacement value over time. So you really get the inflationary kick. If you're in a business such as the utility business or the railroad business, it just keeps eating up more and more money, and your depreciation charges are inadequate, and you're kidding yourself as to your real economic profits. So any business with heavy capital investment tends to be a poor business to be in inflation, and often it's a poor business to be in generally. And the business where you buy something once, a brand is a wonderful thing to own during inflation. See's Candy built their brand many years ago. Now we've had to nourish it as we've gone along, but the value of that brand increases during inflation, just as the value of really any strongly branded goods. Gillette bought the entire radio rights to the World Series in 1939, and as I remember, it cost them $100,000, and for that they got to broadcast the Yankees, I think, versus the Reds in 1939. And think of the number of impressions they made on minds in 1939 dollars for $100,000, and they were getting into the minds of young guys like myself. I was 8 or 9, and millions of people, and they did it in those dollars then. And of course, if you were going to go out and try and have a similar impressions on millions of minds now, it costs a fortune, and part of that's due to inflation, part of it's due to other things. But it was a great investment which could be made in 1939 dollars that paid off in terms of selling razors and blades in 1960 and 1970 and 1980 dollars. So that's the kind of business you want to own.
Inflation, Keynes said it many years ago that it's an invisible tax that only one man in a million really understands, and it's a tax on people that have had faith in their currency that the government's issued. The best protection, the best investment against inflation is to improve your own earning power, your own talents. Very few people maximize their talents, and if you increase your talents, they can't tax it while you're doing it. They can't take it away from you. So if you become more useful in your activities, your profession, doctor, lawyer, whatever it may be, that is the best protection against a currency that might decline at a rapid rate. The best investment, passive investment, I think is a good business. If you own an interest in a good business, you're very likely to maintain purchasing power no matter what happens to the currency. But it's interesting. In the United States, the value of the dollar since I was born has declined by 94% to 6 cents. So inflation is a very cruel tax on people who believe in fixed dollars, but things can work out pretty well even during inflationary times. I mean, if somebody told me when I was born, that the dollar bill is going to go to 6 cents, I might have said, let me go back. I'm not interested in emerging into that kind of a world. But actually, it's worked out pretty well, so I have no complaints.
There's no question that the lack of inflation is a plus for owners. I mean, the real return you will obtain, in my view, from owning American business, if purchased at similar prices, the real return will be higher if we have long periods of low or close to no inflation than if we had long periods of high inflation. I don't think there's any question about that, because that article went on to explain how you got taxed on nominal returns and fictitious returns in real terms. So your question is about which period is better for investors, a low inflation period over any long period is better for investors. The problem, as you pointed out also, was the starting point in terms of predicting modest returns for equity investors. The returns weren't necessarily so modest, I predicted. They were just modest compared to what people had begun to think returns would be during that long bull market from 1982 to 1999. There were polls taken by Gallup, working with, I think, Payne Weber at the time. Now they've moved it over to UBS Warburg, that showed the expectancy of people in the stock market, and those returns that people expected got up to 14 or 15%, as I remember. And they were thinking they were going to get 14 or 15% in a low inflation environment. Well, that was dreaming. And there's nothing wrong in a low inflation environment at all in earning, 6 or 7%. That's probably as well. Well, it is as good as will happen, because in a low inflation environment, how much is GDP going to grow? Well, GDP, if you have a 2% inflation and even 3% real growth, you're talking about 5% in nominal terms GDP growing. If GDP grows at that rate, over time corporate profits will grow more or less at that rate. And if corporate profits grow at 5% a year, the value of those corporate profits, the capitalized value, will probably grow at something like that over any long term with a sort of a normal starting point. And add that to dividends, and you will get 6 or 7% before frictional costs. Investors incur a lot of frictional costs. They don't have to, but they do, and that often is 1.5%, 2% of their investment. So the math isn't bad. It's just bad for those people that got used to or expected very high returns based on looking in the rearview mirror back in 1998 or 1999. Charlie?
My general attitude is just slightly more negative than Warren's.
You've heard it, folks. That isn't the end of the world. I mean, in effect, if the people who own American business get 5 to 6% of the pie, $10 trillion economy now, someday a $20 trillion economy. But if we get 5 or 6% of the pie, those of us who put our capital out to produce goods and services for American business, for American consumers, American population, is that I don't know whether that's, is exactly what somebody who designed the universe would come up with, but it doesn't strike me as crazy in either direction. I think that that's a lot of goods and services to go to people that put up the capital, and you've got 100 million plus people in the working force that are working to turn that out for you using your capital, and it provides what I would regard as a pretty decent real return if you have low inflation. If you get into high inflation, as I wrote about back in '77, you could easily have the real return to investors get to a very, very low number, and perhaps negative. I mean, inflation can swindle the equity investor, as I wrote back then, and I used 7,000 words to explain why, and we'll be glad to send you a copy of that article if anyone's still interested. But inflation is the one thing that over a long period of time can turn investors' results in aggregate into a negative figure. And it's the investor's enemy. Charlie, does that bring forth any further thoughts?
I don't think you'll get perfect help on these subjects from the economics profession either. They have certain standard formulas. To an economist, when a manufacturing job goes to China, that's just so much productivity increase. And if you ask one, well, suppose all of the manufacturing jobs in America went to China, wouldn't that be a little too much efficiency increase? And their answer would be no.
This question comes from Mark Jordan in Charleston, South Carolina. He writes, in a period of high inflation, which particular businesses owned by Berkshire Hathaway will perform the best, and which will perform the worst, and why?
Well, the businesses that will perform the best are the ones that require little capital investment to facilitate inflationary growth, and that have strong positions that allow them to increase prices with inflation. And we have a candy business, for example, and the value of the dollar since we bought that candy business has probably fallen at least 85%, I would say, 80 to 85%. And that candy business sells 75% more pounds of candy than it did when we bought it, but it has 10 times the revenues. and it doesn't take a lot more capital. So that kind of a business, any business that has enough freedom to price to offset inflation and doesn't require commensurate investment or huge investment to support it, will do well. Businesses like our utilities, which get in effect a bond-like return, but require, if you're going to build a generating plant, it costs twice as much per kilowatt hour of capacity. All you're going to get is a fixed return, and yields on bonds go up, perhaps dramatically if you get high inflation, is not going to do that well in an inflationary period, just because it has certain aspects of a bond-like investment, and bonds generally are not going to do well in inflation.
The best thing is to have a lot of earning power of your own. If you're the best brain surgeon in town or even the best lawyer in town, you will retain purchasing power in terms of your income no matter what happens, whether people are using seashells for money or whatever as time goes by. But in the investment world, it's tougher. But Charlie and I think the best answer is to own fine businesses that will be able to price in inflationary terms and will not have huge capital investment that is required to handle the larger dollar volume of sales. Some years ago, I used See's Candy in the annual report as an example of the kind of business that more or less can handle an inflationary world and maintain investment and value no matter what happens to the currency. Unfortunately, most businesses will not come out well in real terms during inflation. Earnings may go up a fair amount over time, but they're compelled to put more and more dollars into the business just to stay in the same place. And the worst kind of a business is one that makes you put more money on the table all the time and doesn't give you greater earnings. So you really want a business can have pricing that reflects inflation and does not have very much capital investment that reflects inflation. But inflation is the enemy of the investor in terms of real returns. As you know, there are, in this country as well as a half a dozen other countries, there are what they call inflation-protected bonds. We call them TIPS in the United States, where the income is adjusted, or the principal amount is adjusted to inflation. And that's not a bad investment for people that have worries about inflation heating up. And I think, incidentally, we're starting to see it heat up in this country.